Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and today I want to run through a project that we've just finished recently to give you some real numbers, some real timelines, and some actual outcomes. And all these timelines are legitimate. All of the numbers are legitimate. Just literally pulled everything from our project management software and property management software. So if you've been wondering what the numbers look like in a real deal, a finished deal, including build times, build costs, then this is a podcast for you. Now, I will warn you that there is going to be a visual component to this. So if you're listening on Spotify or Apple, I would recommend trying to log on to YouTube and watch the visual component on YouTube, because I'm going to share with you the Financial Freedom Blueprint, which is the spreadsheet that we use to show our clients how effective their investment is going to be to help them achieve their goals faster so they can retire early and live life on their terms. So the project that I want to tell you about today is the backstory on this is many, many moons ago, I was in the oil and gas industry. If you know the backstory, I came to this beautiful country in 2010 as an electrician with a bag of clothes, a toothbrush, and my passport and my bank card. I had $8,000 to my name. And very fortunately, I got to live with a friend that was from the same place as me back in the UK, him and his beautiful wife, Jamie and Haley. They had one of the houses that we talk about a lot, or used to talk about a lot when we did conversions, but your typical 4-bedroom, 2-bathroom property. It was down in Port Kennedy. So lots of English people down there. It was easy lifestyle for me to adjust into. But the property had a games room, a theatre room, a study, a family room. This thing was huge, right? 280 square meters on the roof, plus the garage. Absolutely huge house. And he rented a room to me for $50 a week. And if it wasn't for him providing that affordable form of accommodation, I would not be in this position that I'm in today, because $8,000 in this country does not last you long, especially when you need things like printers and internet connection. And yeah, I came literally just on a whim, and I had to transfer my skills from the English equivalent, which was called City and Guilds. I was a gold class electrician, I think it was called. Can't remember, it was that long ago. And then I had to become a licensed electrician in Western Australia. But I had to work as a trade assistant until I got my full Australian electrical license. And again, if I wasn't in that affordable form of housing, I wouldn't have lasted long in this country, and I probably would have went back to the UK. And the reason that I tell you this story is because once I actually got my license transferred, I got sponsored straight away, because electricians are in big demand in this country. And then I also got pulled into the fly in, fly out world. And one of the big projects that I ended on was the Gorgon project, which was for Chevron on Barrow Island. And I met the guy whose project that we're going to talk about today on that project, on the Gorgon project. So this guy, we used to play soccer together on, I think it was like a Tuesday or Wednesday night on one of the soccer fields that was in the Gorgon project. I mean, the camp that they built there was incredible. And again, just built small rooms, fully ensuited with, very basic things in there. And then they had a common area, and then they had somewhere everyone went to eat. Sound familiar? Affordable housing is here to stay, guys. I don't care what you say. It's always been there. We just need more of it. And we continue to build the wrong size housing for the market, specifically for the rental market. And that's why I think, and I truly believe, hand on heart, that this style of housing is going to be here for a long, long time. Whether it's in Western Australia, whether it's in Queensland, New South Wales, or Victoria. But the beauty of this is this guy, seeing me on that project with him, and then through the power of social media, somehow I ended up back on his Facebook feed, and he reached out to me and said, "Man, I'm literally just about to buy another investment property, and I've seen your the stuff that you've been putting out there. I'm keen to talk to you more about if we can use your style of housing as our next property. And they had a negatively geared property and they had their principal place of residence. But because he was in the oil and gas industry, he had strong serviceability and he was in a good financial position. So we went backwards and forwards talking about the different options that we could help him with. And we managed to find him a block of land in South Guildford, which was 20 k's from the CBD. And what happened was the land currently at the time was not titled. So we had to wait until it was titled. Now, the beauty of that is, whilst he had signed an expression of interest and put $5,000 down on the block of land, that land was increasing in value every single day because of the demand that's out there in the market, right? So $5,000 to control it. That was on the 5th of October, 2023, right? And we secured that block of land for $330,000. It was then titled in February 2024. And once we got the titles, we could then apply for finance. And the property settled on the 24th of May, 2024. Now, there was a few delays with finance, and it was just at a time that the lending parameters around HMO and co-living changed significantly. We went from an 80% LVR down to a 70% LVR, which meant he had to put more cash into the deal. But I'm going to show you what that looks like when I share the feasibility with you pretty soon. So settled on the 25th of the 4th, 24. Then we went through some issues with getting approvals on this. Nothing to do with our end of the story, just getting CDC and bad timing that we got the slab down in March 2023. Now, the builders, March 2025. Now, the builders that we used on this project were the builders that we used to use for all of our renovation projects as well. And they transitioned from renovations into new build. And this was the first project that they actually did for us, right? The pricing was very, very sharp. It was probably about 50 or 60 grand cheaper than some of the competitors, but because their overheads were low, it meant that it was attractive to our client, but it took them a long time to get their documentation together, get it all approved, and then get build permit approved, which meant we only got slab down quite a time later, right? Which was in March 2025. However, the client, knowing that he was getting this build for significantly cheaper than some of the other builders, was happy with this. So we poured the slab in March 2025. We handed that property over in Feb 2026, so just under a year. And what happened is we then put the furniture pack in, and then we did a home open at this property on the 25th of February, 2026. Now, we put a email out to our database of investors to ask people if they wanted to come through to come and see a finished HMO. It had furniture in there. It was literally getting handed over to the property managers the next day. We had over 80 people attend this home open, which was staggering. There was people everywhere. It was crazy. I had myself and I think 5 or maybe 6 of my team members there, and they were just flat stick for hours. But the place was buzzing. So many questions, so many people inquiring on this. If I take myself back to like 2020, 2021, we maybe get like 6 to 12 investors coming through these things. And this is a change in the sign of the market, right? People are starting to accept this style of housing more and more. Investors are starting to see the benefit of positive cash flow and capital growth and debt reduction in the same deal. And that's why we had over 80 people turn up for this property. We then handed over the property management team on the 26th of Feb. And all 6 bedrooms were filled by the 10th of March, 2026. That is 12 days to fill all 6 rooms, 20 k's from the CBD. Now, I'm going to run you through the feasibility very shortly. However, I want to just go back to the start of this conversation where I told you that we picked up the block of land for 330 and he was getting capital growth on a deal before he even settled in it. And even when he settled on it again, he was getting even more capital growth. So now to buy a very similar size block of land in this location, you're paying $475,000. That is 150k, 145k more in 2 years. Not bad. Not like some areas have gone even more than that, but still not bad, right? And that house he paid $607,000 for that property, for the construction. Like I said, these guys are coming in cheap. Our nearest competitor was coming in at like 660, 670, 680. And then furniture pack at the back end was $40,000 as well. Now today, that exact same 6-bedroom, 6-bathroom build, same spec, same size, same everything, would cost $740,000. So what cost him $977, including the furniture pack, and if you take that out, it was $937. That property would now cost $1.25 million, which is a $238,000 uplift and 25% capital growth. So not bad, right? This is proving that we get cash flow and capital growth in the same deal. And I know you're going to say now, Neil, tell us the numbers. Tell us the numbers. So we initially estimated that this location would receive room rates from anywhere from 325 to 350. We tested the market using our market testing technique, and we were getting positive feedback at 350, which gives us the confidence to move forward and build this property in this location for this investor. And this is how we de-risk these investments for our clients, by testing the market and using the data that we've collected since 2017 to know exactly where people want to live, and more importantly, how they want to live and what they need and want in their rooms. Now, we put $350 per room into the feasibility. So if you times $350 per room times 6, that gives you $2,100 per week. And if that gives you $2,100 per week times 52 is $109,000 of gross rental income. $109,000 from a property in the same street as something that might rent out for $700 a week, which would give you $36,000 a week. So you're making more than $85,000 and $90,000 more by building a very similar property. Like you would walk past this property on the street and you would not know that it's a cash flow machine. It looks and feels like a normal property from the outside. It's just laid out differently on the inside. So $109,000 a week on the purchase price, that gives them 11% gross yield, right? Which is good. Don't get me wrong, our target is anywhere between 9 and 13% for our clients. The days of 13% are getting harder and harder to get nowadays. But especially at feasibility stage. So we always talk about feasibility stage and actual, because feasibility stage, there's a 12-month lag between us presenting a feasibility to you and us handing it over, putting furniture in and putting tenants in there, right? And the beauty of this style of housing, or this way of doing this, is you can, again, secure your land during construction. You're getting capital growth. Your property's going up in value. But what's also happening is demand in the area for rooms is also increasing too. So as the room demand starts to increase, more and more people are starting to look in the area, which means we're pushing the room rates up. And we actually ended up renting all the rooms out in this property from an increase of $2,100 a week to $2,345 per week in 12 days. That is $245 extra per week, which is $121,940 per week. And that actually gave the client a 12.4% gross yield on his investment, because we work it out on the purchase price, not what it's worth now, because we're working out how hard your money is working for you, so that you don't have to keep working hard for your money. So now I'm going to, for the people that just love numbers and love detail and love structure and love spreadsheets, I've got a little treat for you. I'm going to run you through our financial freedom blueprint. So this is where, if you're listening to this on Apple or Spotify, you might want to switch over to YouTube. However, if you are watching on YouTube, hello. How do I do this? Probably should have tested. There we go. Okay. So now you should be able to see. Yes, you can. You can see my financial freedom blueprint spreadsheet. So, as I said earlier, we've got a 6-bedroom, 6-bathroom property. We paid $330,000 for the block of land, and the construction cost was $607,000. Now, as we said earlier, when we first started this project, in an ideal world, it would have been at 80% LVR, which meant you would have had to put 20% deposit down, which on 937,000 is $187,000. Now, there are other things that we need to factor into that deposit, because if you just turned up with $187,000, then unfortunately you are going to be disappointed, because there's a lot of other fees that you need to consider, which is firstly our HMO concierge fee. This is our fee to source, project manage, and deliver these properties for you. You need to consider your deposit. You need to consider your stamp duty on the block of land. You need to consider your holding costs during construction. You need to also consider other purchasing costs like valuations, legals, inspections, setup, depreciation schedules, all that type of stuff. And then you also need to factor in your furniture pack as well. Nowadays, we manage to put the furniture pack into the bill contract, so that when we give you your construction cost, it's all included with the furniture pack in there as well. So to do this deal, the client needed $297,000, or so we thought originally. But when we needed 70% LVR, it then increased the deposit to $281,000, which meant we needed $390,000. Now, again, luckily, we'd just been through some really strong capital growth. They had a lot of equity in their principal place of residence and a lot of equity inside their investment property as well. So to get hold of an extra $100,000 wasn't a big struggle for these guys. And what we're seeing as well is during construction, we accessed a construction loan for 7.39%. And then when the property finished, we switched over to a lower interest rate, which was sitting around 6.5%. So as you can see, if you are watching on the spreadsheet here, we've got our room rates at the estimated value of $350 per week. Gives us $2,100 of weekly rent, $109,000 of gross rent, and then we factor in the cash flow forecast, which I'm about to show you in a minute, 3% annual room rate increases, which is very conservative. I think we could probably push that up to 5, but I'll leave it at 3. And then we also factor in a 5% vacancy per year, which is 18 days per annum per year. We just filled all 6 rooms in 12 days, right? So we've already got a bit of a buffer up our sleeve in year 1. And the beauty of these things is our average tenure right now is anywhere between 18 and 24 months. So the chances of anybody moving out in year 1 or year 2 is quite slim, which means that when I show you the cash flow forecast again, there's a line in there which says vacancy, and we allocate that 5% vacancy every single year into the cash flow forecast. And if you don't have that vacancy, then that figure goes straight to your bottom line as an additional cash flow for you as the investor. We've also got things like property management fees, leasing fees, land tax, council rates, water rates and usage, repairs and maintenance, insurance, gas, water, electric, internet, and cleaning, which altogether comes to around $34,000 per year, roughly. That can fluctuate less or more. It's always better to stress test it more, right? So even though it says 34, we'll probably just chuck another $2,000 in there. You know, in your first year, maybe your first 2 years, you shouldn't have $1,000 for repairs and maintenance. So we've already got a bit of a buffer in that spreadsheet anyway, right? Next, we are going to go down to the cash flow forecast. Now, this is where it's going to get exciting for the people that love numbers. As you can see here in 2026, we've got cash going out the door, which is your holding cost during construction, because we have got no tenants in place. We haven't even got a house yet. We just got a pad and we're about to build it. So during that first year, you're going to have your holding costs out the door. And we've got it in there as $24,000 per annum, which is 7.39%, factored in at a full year's holding costs. So 70% LVR loan, we've got a $655K loan, 7.39%. Holding costs on that should be $24,000 per annum. We have also got your cash going at the deal at 281, and it's showing here that your LVR is 70%. Now we move into the next year, and I probably should have did this as 2024, 2025. In fact, let me just quickly change that so it's a bit more reflective of the sign of the times. And let's just pretend we built it in 2025. So 2025, we built it. 2026, we then switched to the lower interest rate. I'll put it at 6.5%. And I'm also putting in here as well that we're getting a capital growth rate at 6% every single year, right? Again, conservative over what just happened, but people might also say it's optimistic over the downturn that Perth had. At the end of the day, all markets have ebbs and flows. They go up and down. And 6% is the Perth national average over the last 20 or 30 years. So as you can see here, we've got $109,000 of gross rental income. We've taken away $5,460 for your vacancy allowance. And as you can see in year 3, 4, 5, 6, and 7, we factored that in as well. In fact, it increases every year because this factors in the room rate increases and also factors in CPI. So in year 3, for instance, we've got $5,624 for vacancy allowance. And if that does not happen, if no one moves out, that's an extra $5,000 of cash flow straight in your pocket. So after our gross rental income and take away our vacancies, we've got $103,000 of adjusted rental income. From there, we've got our property management fees and operating expenses, which leaves us with $69,000 before interest or before holding costs. And then our loan repayments are principal and interest, right? So principal interest loan, 6.5%, is $49,749 per annum. And that is broken down into $42,000 worth of interest and $7,300 worth of principal. Now, even after paying a principal and interest loan, this property is still cash flow positive of $19,000 per annum. $19,467 to be precision. Now, what I'm also going to do is, because we've got 19,467 plus we've got $7,331 worth of principal. So technically, this property is cash flow positive by $26,798 per annum, which is good, right? And again, if we factor in your vacancy, for instance, in year 3, because your room rates are going up, and because in this cash flow freedom, financial freedom blueprint, the cash flow figure in the green line here of 19,467, this also allocates that to the principal in the following year so that it reduces your principal even more, right? So you can either keep the $19,000 in your pocket, or you can pay $26,000 off your loan. And what that means is, if you use the cash flow every single year, now, if you're a working professional, you've got a good income like these two have, an extra $20,000 a year, yeah, you're probably going to get a holiday out of it. However, if you delay gratification, then this is where the beauty of investing comes in and the power of compound interest. If you delay gratification and we fast forward 15 years, and let's think 15 years isn't that far away, right? But in 15 years, your property could be debt-free in 15 years because you've used the income from the property to reduce the debt, which is give you an unencumbered asset. When you've got no debt against your property portfolio, who cares what the RBA does? Who cares what rates the banks are doing? Because you do not need the banks anymore. In fact, the banks need you more than you need them. Banks are in business to lend money out. The beauty of this is, when you are debt-free, this property will generate $104,000 per annum after all expenses. That's not a bad spot to be in, right? And don't forget, we paid $937 for this property, and it's now worth $2.245 million. So you've gone from a $390,000 deposit and turned it into a debt-free $2.2 million asset. Now, the beauty of this is, I have still been showing you the numbers based on $350 a room. So I'm going to quickly put the actuals into this and actually show you what this property is generating. So we've got $405 a room, $395 a room, $380 a room, $380 a room, $380 a room, and $405 a room. So we actually got $2,345 a room, like we said earlier, per a room. That'd be nice, wouldn't it? 2, 3, 4, 5 per week. $121,940 per annum of gross rental income. Now, in year 1, we have gone from, I think it was $19,000 per annum. we are now sitting at $29,000 per annum of net cash flow after all expenses, and that's also paying down a principal and interest mortgage. So if we now add 29,661 onto the $7,331 that we are paying in principal anyway, we are reducing our loan by $36,992 in the first year of operation alone. Now, what that does is now you're not paying your property off in 15 years, you're paying your property off in 13 years. Pretty cool, right? And when we pay it off faster, it means that because we've got the higher room rates, your property is now kicking out $113,000 per annum. And because we paid it off faster, we haven't got as much capital growth yet, but you've still turned $390,000 into $1.9 million worth of a debt-free asset, which generates $113,000 per annum. When you look at these figures, it's just absolutely mind-blowing, isn't it, right? How you can invest in one property and potentially create financial freedom for you and your family. One property. Imagine what two looks like. Imagine what three looks like. Two properties would give you $226,000 a year. Three properties would give you $339,000 per year of net cash flow after all expenses. And you can refinance these properties, pull cash out and do your second one, which is exactly what this client is doing. We've already secured a second block of land for him, and we are just going through all the build permit approvals right now so that we're going to move to site ASAP. Now, there is one more line which I want to show you on this feasibility, right? And this is this one here. It says running LVR, and also just above it, we've got annual total equity, right? So in year one, we had $281,000 of equity and a 70% LVR. At the end of year two, we paid down debt, which means, and the property's gone up by 6%. So we're building wealth twice as fast as everybody else that's just chasing capital growth. We've increased our wealth by an extra $33,000 this year. Doesn't sound like much, but compound that year on year, and you can see the benefits by looking at this feasibility. So your equity has gone from $281,000 to $344,000, and your LVR sits at a 65% LVR. Now, let's just fast forward to year five, which is actually just 4 years of operation. You've gone from a $281,000 equity position to a $659,000 equity position and a 44% LVR. That is because you were paying down debt while your property is going up in value. And then if we fast forward another 10 years, if we just fast forward to 10 years, then I'm going to take that replace furniture pack out. 10 years, we can see there that your property will be generating $72,000 a year. So at year 10, you are actually paying off $72,000 plus $12,000. What that? 84,600 and something. You're paying 84 grand a year off the debt. So you're not only reducing your loan term, right, but you are saving hundreds of thousands of dollars in holding costs to the bank. This is one way that you can use the banks and play them at their own games by investing in cash flow positive assets instead of investing in capital growth only properties. Now, capital growth only properties have a place in the market, right? You should be using them to build enough equity to then invest in an asset class like this, because this is just set and forget. You set these things up, they'll look after themselves. My team will do everything that needs to be done. We'll find the tenants. We'll look after the tenants. We'll look after any maintenance that pops up. And more importantly, we will drop a lot of money into your bank account every single month. And you deserve that because you are then building a style of housing for the market, which we need. You are helping to solve the affordability and the housing crisis, which we have right across this country, whether you invest in Perth or anywhere else. And you deserve the benefits and the outcomes that you get for investing in this style of property. It's a win-win-win situation, team. So there you go. I hope that helped. I hope you got a lot out of that. I hope you got a lot of questions. If you've got questions, by all means, feel free to DM me. Feel free to email me, neil@colivingcollective.com.au. If you want a copy of the feasibility, please share a copy of this podcast or this YouTube episode with a friend. Take a screenshot proving that you've shared it, and I will send through a copy of the feasibility for you to have a play with yourself. My name's Neil Gibb. Join me again on the HMO Property Show, and I'll see you next time.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.